Welcome back to the PreVetted Podcast, where we spotlight extraordinary people and remarkable talent reshaping our world. Today, I am joined by Marc Shenkman. He's president and co-founder of Priority Financial Network, a privately owned mortgage banker based in Calabasas, California. Marc has spent decades in mortgage and finance, from trading mortgage-backed securities and hedging institutional portfolios at major firms to building and leading mortgage businesses that have funded billions in home loans. Marc also serves on the board of the Community Home Lenders Association of America, an organization representing independent mortgage banks. Marc, welcome to the show.
Nice to be here, Federico.
So, for people meeting you for the first time, can you tell us a little bit more about what you do today?
Yeah, and I'm going to use the same line I used when my son joined the company. What we do is we solve problems, and the problem that we solve has to do with mortgages. So, for example, a borrower who needs to buy a house for his family, we solve that problem. We help them with getting the loan and the proper loan that fits their needs. Somebody who needs money for home improvement, somebody who needs to lower their rate. That's the problem that we try to figure out how to help them. And to me, going in with that attitude makes you sound a lot less like a, schlocky salesman and more of a guy who's there as an advisor.
Amazing, amazing. And what is Priority Financial Network, and who do you mainly serve?
So we are, like you said, an independent mortgage banker. So that distinguishes us from two other avenues of mortgages. So there's, for example, banks, savings and loans. There's not as many savings and loans. Credit unions they're lenders also, but they are depository institutions. So they lend based on the money that they have on deposits. And then there's mortgage brokers. Mortgage brokers are usually independent loan officers who do not have any skin in the game, as we say. They will be a middleman in between the borrower and the eventual lender, and they'll get paid a fee for that. Usually the fee gets paid by the lender, but it could also be paid by the borrower. An independent mortgage banker is somewhere in between those two. We have our own money. We lend the money through, we have large lines of credit. We establish guidelines. We will then fund your loan. The rhetorical you, I guess. And then we will package them, securitize them, sell them in bulks to the agencies who are, Fannie Mae, Freddie Mac, the FHA, VA, things like that. Or in certain cases, we may have private investors or private equity funds or who will buy the loans from us, or even someone we call aggregators who will like to buy the Fannie Mae loans and securitize themselves. So we sell many, many different platforms, but we at one point were at risk because we're lending our own money. And that's primary difference between us and, say, a mortgage broker.
Right, so you manage other people's money rather than your own.
Well, it's our money, but we have like large credit lines. So a bank will give me, say, $100 million line of credit that I can use to lend out. And then every time I fund a loan or a group of loans, we package those loans into securities or we sell them one off. And then that pays down our line. And the difference between what we call our gain on sale, when we sell the loan, we try to sell the loan at a profit. We try to price the loan at a profit. And that difference stays with us, and then the line gets paid back down. And that happens many times a day with us.
Right, right. So it's about distributing the risk and managing the loan rather than who owns the money.
Yeah, I mean, we're constantly managing risk, and we're managing risk not only for ourselves, but who we sell the loans to, right? Like if for example, if I'm selling loans to a large bank, say US Bank, if I'm selling them bad loans, they're not going to buy loans from me anymore. So, we try to make sure that our loans fit the quality and the parameters that they like. And we don't want them to, to get a bad loan, either fraudulent or borrower who just doesn't make his payments, that kind of thing.
Right, right. Yeah, because those, I've seen that happen with people that cannot afford to continue paying, and those eventually go to a loss, right? To a loss department that
Yeah, in
manage
our
that.
business, Yeah, in our business, we have when we sell the loan's gone. We don't have it anymore. But if the borrower misses payments in the early period, what we call the EPD period, the early payment default period, which is say in the first 3 to 6 months, if the borrower misses payments, then we may be responsible for repurchasing that loan. So, we're going to underwrite that loan to make sure that doesn't happen. And if the loan has any fraudulent documents or the borrower misrepresented something, that could also potentially come back to us.
Right, right. So there's a lot of liability that you're handling, and that's part of the business, right? I mean, reducing that liability and be able to arbitrage the uh, the profit of those
Exactly.
loans, right?
Right. And we have systems in place. We've got underwriters, we've got processors, we've got doc people. So it takes a whole team to get a loan done. And so the underwriters are making sure that the borrower can qualify for the loan based on the parameters that he's applying for. And then, our document people make sure that all the documents are good and that the borrower signs legitimate mortgage documents.
Right, right. Yes, that makes sense. I've been researching about how different is the risk management in the US compared to Latin America, where there is no, the concept of background check, formal background check doesn't exist. You get
Yeah.
some,
I mean,
you have,
sorry to interrupt. Go ahead.
yeah, you have a few companies that do credit scores, but the way that it's being done background checks in the US, it's holistic. It's credit, behavior, loans, debt. It involves,
Yes.
you know, everything, right?
There's 4 C's that we look for: the borrower's credit, his compensation, his cash, basically his liquid assets. Wait, is there? Oh, and the collateral. Almost forgot the 4th C. So, the quality of the property they're buying. So, like, for example, on the collateral, we're going to look at the appraisal, make sure for example, on a purchase, that the borrower is paying the right amount for that house. If he's buying a house and it's $500,000 and it's only worth $400,000, that's going to present, a problem on the loan. And second of all, we're going to look to see that the borrower has the income to support the loan and the assets for the down payment and reserves. And finally, that he's got good credit. I want to make sure that the borrower pays his debts. If a guy who's consistently late on installment loans or other mortgage loans, they present a higher risk. And you're right, that is what's kind of different in the United States. We're the only country that I know of that has that 30-year mortgage. And, you go to other countries, there's short-term loans. I think in England, I think loans only go 5 years. In Australia, same thing. So we're very unique in that respect, and that we have an active mortgage market and an active secondary market. And that's, the primary role of Fannie Mae and Freddie Mac. And then, of course, the first time home buyer and, trying to get people into homes with very little down. That would be, something that the VA and FHA, Federal Housing Administration, that's their primary focus. And that makes us unique compared to, like you're saying, in Mexico.
Right. Yeah, it's very interesting how it's working here, and you can actually cannot use as a collateral another house, another property, only your income as a collateral, which is, the system in Mexico at least doesn't have a memory, right? It doesn't matter if you have 10 houses, they only check your income, right? Which is
Right.
interesting. Yeah.
Yeah, the problem here is that we also have to we got the federal government, and then we have 50 different states. So, they're different. Each state has different mortgage rules. The federal government has its mortgage rules. And then we've got the Consumer Finance Protection Bureau that has its rules. So yeah, we're probably the most regulated industry in the country.
Right. Right. Yeah, but also you have a lot of responsibility as a business, and also you're changing people's lives by being able to help them buy a house, right?
Yeah, I mean, like I said, we're selling money. It's a pretty easy sell, right? Like, our job is to get you the best possible interest rate that you qualify for. Most borrowers, most people, the most important thing in their life is their mortgage, right? Because, the house might be their biggest asset. So, all of that combined means that, we we really have to act as advisors and make sure that, the borrowers, are treated right, but they're also, This is a long-term thing for them. We're talking about a loan they might live with for 30 years. Granted, most loans don't go 30 years. People sell, people move, things like that. This is a long-term and investment, and usually a big portion of people's net worth. So you're right. We have a strong fiduciary relationship with borrowers.
Right, right. And as you mentioned, you're also taking care of giving the people a better a good financial product that they can afford, right? Because they all have dreams, they all have, they want a bigger house, but if they cannot afford it, what's the point, right?
That's exactly right. I mean, I've had a number of borrowers that we've talked to in the past that will say, "Oh, I really want to buy this house." It's like, dude, you can't afford that. Right. I mean, or maybe, yeah, you can afford that, but you're going to be eating ramen noodles every night because you're not going to have any money left over. So part of our advice has to be, hey, this is just over your head. So people, and that's what happened in like 2000, up until 2007, 2008, back in the go-go days when the mortgage market almost collapsed the whole world economy. People were putting zero down, getting loans they couldn't afford, and it didn't help anybody out. It collapsed the real estate market in the US. There are systems in place today to prevent that kind of thing from happening again, I think. But at the end of the day, people borrowed money that they were never going to be able to pay back. And that doesn't do anybody any good. It hurts their credit. It hurts the whole real estate market. So the most important thing is making sure that the borrower can comfortably afford that mortgage.
Right, right. I lived a few of those crises in Argentina where the highest income could access credit and the interest rates were so high because the economy was so unstable, right?
Right. Yeah. No, it's, that I never want to relive those days. It was a rough day to be in this, a rough time to be in this business. But, the people got into, I got to own real estate, and they bought things they shouldn't have bought. There were people that were taking loans that had very high interest rates, and their only plan was to buy a property and sell it when up in value. And that's not a plan, right? Like, you don't know something's going to go up in value. That's not a good business plan. If you're buying something, it's got to be a house that you want to live in. Or if it's an investment property, what's the transaction risk in the property as opposed to the market risk? Is this going to be a good rental property, or you're going to fix it up and create something different? Buying something just hoping the rate, that it's going to go up in value is a bad plan, because properties go up and down. And back then they went down considerably. Real estate in the country dropped, 40, 50% in some places. I think in
Yes,
Las
yes.
Vegas,
I mean,
there were condominiums that, you could have gotten for, $50,000. Everything,
wow.
they were big buildings sitting empty. I know. I wish I'd bought a bunch.
Yeah, I
They're
mean
like
that's
million
what I
dollars.
was going to say. I
Yeah.
mean, if you were able to hold those properties, which most people could not, you could make a big difference. And yeah, I've seen that happen.
Yeah.
Um,
Well, private equity funds went in and bought a lot of these foreclosed properties they're still holding on to, and they've made a fortune.
right.
Yeah.
And they can leverage they can loan over those assets and without selling it, right? So that's very interesting as well.
Yeah. Money talks, bullcrap walks, right? Like, if you've got billions of dollars in the bank, you can go out and buy a lot of stuff, and wait it out. Because, for the most part, especially in good urban areas, I'll use Southern California, for example, holding on to a property, the longer you hold on, the more likely it is it'll go up in value. Now, there's markets that don't have the appreciation that, say, Southern California have, but generally, over time, real estate goes up in value. Um, I mean, think about it. It's more expensive to build a house today than it was, 10 years ago. Land is more scarce. And in the meantime, this country is short homes. We need to, just to keep up with current demand, we need to build 3 million new homes now. And so that's going to keep prices up because of supply and demand, right? Supply and demand are not in balance right now. And there's less supply and more demand. And especially if we see a drop in interest rates, I think that you'll see even more price appreciation.
Right. Um, I want to tell you a story about a loan that I was able to arbitrage.
Yeah.
So I got a loan in 1990, 2001, right, in Argentina. And in November of 2001, there was a crisis where all the currency between peso and dollar went from 1 to 1 to, open rate, market rate. So it
Mhm.
went from 1 to 1 to 3 to 1. And the next year, in 6 months, it was 5 to 1, right? Now, all of the credits were in dollars. So after the currency exchange crisis, then came the real estate crisis because properties were valued in dollars, loans were valued in dollars, but now everybody earned a third or a fifth in dollars. So it became, a lot of foreclosures, a lot of issues because people could not afford to pay the loans anymore, right? So I got a loan 2 weeks before all that, right? Uh, in dollars. It wasn't that much, but it went from being I don't know, a 10% of my salary to 50% of my salary, right? Or whatever number.
Painful.
Yeah, yeah, yeah. But the government did a rescue thing where they draw a line on the sand and they say anything below this we're going to convert to pesos. Anything above this we're going to leave to dollars. It was arbitrary, but that saved a lot of people's properties. But also, if you had an expensive house, now you're in dollars, right? Your loan remains in dollars. So my
And did
intention
the
was,
properties go up or down? The properties went down in value during that?
it was crazy because the values of things went up and down throughout those years. How much does something is worth, right? If you have no framework of reference, right? But what happened is, so I used that loan to buy a car, right? Here's the thing. My intention was to pay off the loan very quickly, but with that, the specified loan was less. It didn't make sense to pay it because the interest rates were nothing. I mean, it was 30% year over year, but still, it was nothing compared to the difference. And the car, we sold that car 10 years later, and it was the same amount in dollars than when I bought it.
Got it.
So, and in that process, all the prices of everything goes crazy, right? If you have something, if I have this, how much it costs? Well, I'm going to call the vendor right now to figure out how much it costs before I sell it to you. So it's going to cost whatever the provider says. So there was no price reference for anything, right? So it was 10 times what the '08 crisis was.
Yeah, do remember that happening. And we've seen other market disruptions like that. Argentina was suffering from hyperinflation. And what's interesting is that inflation traditionally has been good for hard assets, gold and real estate, right? Because it's a finite. There's only so much real estate. It's a finite asset. So if the general level of prices is going up, well, then simply, real estate should go up. They're not talking about that right now. We have obviously some inflation going on in our economy, obviously a little bit worse in the last 6 weeks since the war in Iran, because gas is another thing. Oil has a tendency to flow through the economy. We need it for everything. Well, real estate's sort of the same thing. It's price of everything goes up, real estate tends to go up with it. So be interesting during hyperinflation though, if people are losing their homes, then then you've got a supply and demand issue, and then the inflation's not gonna affect because people are, there's gonna be all these homes that are foreclosed on. So
Right,
yeah,
right.
interesting dynamic though.
So the way that I say it here in Mexico on the last 5 years or so, we've seen like inflation going up, right?
Mhm.
Slowly but steady, right? So what I say to my friend is go and take as many loans as you can because money is worth nothing, right? Right now, right? So you get a 10% interest rate and an 8% inflation. You can, and you get a 20-30% up value in the houses. It's worth to get loans and buy property because the inflation is going to eat the interest, and the appreciation of the assets is going to go up.
Yeah, and I think that's um, what you're saying is super important. For example, with COVID and we had artificially low interest rates. I mean, I actually did a loan for somebody, and his rate on a 15-year mortgage, he had big income, was 1.75%. Not funny, but he lost his house in the Pacific Palisades fire, but he's not paying that loan of it's 1.75. 50% of all loans in the United States, I think there's $12 trillion or something like that in mortgages out there. 50% of those are 4% or less. And that's creating a supply issue, sort of like we're talking about, because are you going to sell? Like, if I sell and I have to take a 6% mortgage, that's painful. Certainly not going to refinance. So, you might actually just say, I'm going to take a equity line and rebuild my house. You're 100% right. You've got a 3% mortgage and we've got 3% inflation. You're essentially paying nothing for your mortgage.
Right.
Especially in the US where up for the first $750,000, that mortgage is deductible against your ordinary income. So now your net, maybe your net cost on that loan is 2% or 1.75. Yeah, same kind of thing. Like it's, in our case, we're calling that the lock-in effect. People are not going to sell their homes. And, you're right. The property's going up way more in value than the mortgage is costing.
Right. Right. It's something that people don't think about when they think about inflation. They don't realize they could do this type of math. And the only caveat that I've seen to that is as long as you have the cash flow to keep paying the loan, right?
Yeah, I mean, you've got to make your mortgage payments, obviously.
Yes,
Yeah.
yes. But if you plan for 10, 20 years or, of your life, you have to make sure that you have the funds to keep paying or the cash
correct.
flow or the funds, right? Yeah.
Yeah. If you were to go back about, say, 10 years ago, the average loan, even though we're doing 30-year fixed mortgages, the average loan in the United States stayed outstanding around 55 months, less than 5 years. Again, people sell, they refinance, they die, properties, things happen. Because of that lock-in effect, the average loans right now are running at about 77 months. It's a huge difference, and it's having a big effect on real estate in this country right now.
Interesting. Didn't know that.
Yeah. And it, again, back to that lock-in.
Right. Right. So you mentioned working on legislation that helps the consumer. What is one consumer problem you most want to fix?
Well, there's a couple of things. And, to give you a little context, when 2008 collapse happened, I know it's shocking, but the government overreacted and they came out with a lot of rules in the name of consumer protection, which in my mind is hurting the consumer. And it's something, as we mentioned about my position with the CHLA, we're out there trying. Obviously, we're doing advocacy for independent mortgage bankers, but it's really based on what hurts the consumer. So, for example, the credit report that you pull for a borrower. If I remember correctly, it was so long ago, I've been in this business a long time. We used to spend, I think, $10 or $20 for 2 credit reports. Borrowers are paying like $300 for credit reports right now, which is crazy for a mortgage credit report that costs like $300 for 2 people. You're probably, if you went to your car dealer and got a credit report, he pays like $1. So
Wow.
we're hurting the borrowers a lot on that. Borrowers are way overpaying to pull their credit. And then the other thing is some of the regulations that have come out in the interest of consumer protection. One of them being a perfect example is the 3-day, we're required to wait 3 days to fund a loan until a borrower has reviewed his appraisal report. So on a purchase, for example, you're buying a house, we get an appraisal, we can't close that loan for 3 days. Now that's a right the borrower can waive, and they typically do. But why do we have to wait 3 days? The borrower, he's got a closing date. Sorry, I can't close on that date because you have to stare at your appraisal for 3 days. And that's even true on a refinance. You have to look at your appraisal for the house you already own, like in order to fund a loan that you want. I mean, it's a ridiculous, ridiculous rule. Some of the other rules that they've put into place is the loan officer compensation rules. And that is, and I think this is the only industry in the United States that's regulated like this. The loan officers who work for us, my loan officers, we've got about 100 some odd loan officers around the country. Whatever compensation they want, they have to get paid the exact same amount on every single loan. So if a loan officer is getting paid 1 point, 100 basis points on a $500,000 loan, he's going to make $5,000. But if he wants to give the borrower a better rate and drop his compensation, he's not allowed to do that. That's in order to protect the consumer, the loan officer has to charge the consumer more. I mean, it's completely nonsensical. And there's all kinds
Wow.
of rules like that. It's ridiculous. The loan officers can't lower the rate to the borrower, even in a competitive situation. Even in a situation, so for example, one of the things that we do quite a bit of are down payment assistance loans. So there's all these bond programs. Every state seems to have one. In Texas, for example, it's called TSHAC. California, it's called CalHFA. And basically what it is they sell bonds and they help borrowers with, zero down payment deals. But the compensation to the lender like us is much less. Well, our loan officers can't do those loans to help the borrower out because there's not enough, they can't work for less compensation to help a first-time home buyer get into his dream house. It's ridiculous for legislation. It's something we're working on trying to get rid of. I don't think that was the intent. From what I know, that was not how the law was intended to be, but it's the way it's worked out to be. And it hurts borrowers. And, I could probably go on for hours about how the federal government hurts our borrowers, but all in the interest of consumer protection. So I would like to
Right.
see some rules changed personally for the consumer's benefit, not for my benefit.
Right, because I mean, if you, it's a balance, right? If you put too many regulations, even though they could be with good intention, you cannot see the secondary effects of those, right? They're not considering all the use cases, right?
Yeah, I mean, even the disclosures that we give borrowers, it's ridiculous. I don't think anybody reads those. I can tell you, I mean, I send disclosures to our borrowers. I've never read them. I have no. They're ridiculous. And then the closing disclosure forms, which they spent probably the Consumer Finance Protection Bureau spent hours and hours creating, are so confusing to the average consumer. It's got all these different figures and numbers and everything. And the borrower wants to know is, what's my interest rate? What's my monthly payment? How much is it costing me? And it could be so much simpler than it is. It's broken down. And I mean, the borrowers just don't understand. They're not professional lenders and they just have no idea. So, I mean, we just have over-regulated this business. And that's why a lot of banks aren't even in the lending business anymore. 87% of mortgages are done by independent mortgage bankers in this country.
Right.
Yeah. So the banks don't want and banks are highly regulated and it's too much for them. It's crazy.
Wow, that's crazy. Yeah, I mean, in the story I was talking about the loan that I was taking. I took a loan with a bank, but if I took a loan with a we call it loan sharks in Argentina, but basically it's a private person giving you a loan, right?
Does he break your legs if you don't pay on time? Those are the
We
loan
don't
sharks.
know,
That's the
right?
loan
Yeah,
sharks. Yeah,
yeah,
they
yeah.
break legs.
But it's basically a private person giving you a loan, and those
Uh-huh.
would not be affected by the specification of those loans. So I would have paid in dollars instead of in pesos. So
Right.
I, I dodge a bullet with that, right?
Yeah.
and
Nice.
and still have my legs, right?
Yeah. 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 Yeah.
Yeah,
Here you just lose your house. There you lose your life. So yeah.
right, right. Yeah, so in Argentina, what I've seen happening is people live in the houses while they're building it, right? So they have a little bit of money, they buy bricks, and they build a house, and they stop and they collect more money, and then they keep building, right? So they keep building for 20 years, right?
They
Which
just keep
is,
building onto the same house.
yeah. So they do another room, or they improve the finishing. It will be 20 years of renovations with with bootstrap money, money that they have, right? So Yeah, or they would buy bricks, right? And they would store it on the roof of the house, and that's their savings, right? They save in
Wow.
literally bricks, right?
Yeah. After living through remodels on my own home, I don't know if I'd want to do that for 20.
Oh yeah, yeah. It sucks. And the thing is, it's we're working with wet construction, so it's cement. You have sand. You have all sort of things. So it's more messy than what I've seen constructions in the U.S. Right?
Yeah, that not the tip. It sounds it's there's that it's like that church in Milan that they've been building for 800 years.
Oh wow.
Yeah, I don't
So
know the name of.
so you're talking about that you were on the board of the Community Home Lenders Association of America. Can you tell us a little bit more about what it is and why does it exist?
Yeah, so as I said, so the CHLA we're an advocacy group. Yeah. So we're an advocacy group. We represent a bunch of independent mortgage bankers around the country. There is advocacy groups. There's other ones in the mortgage business, like the Mortgage Bankers Association. They have a tendency to represent the big banks. And I can tell you that what I want to do is completely different than what Wells Fargo and B of A and Chase want for the mortgage business. One of the things that we're working on right now, like I mentioned about credit reports,
Right.
credit reports get a FICO score. I think you've heard of FICO score, Fair
Yes.
Isaac. And that FICO score can determine whether or not you get a loan or the interest rate you get on a loan. That FICO score priced to the borrower in the last 5 years has gone up something like 1,500%. And it's ridiculous. They have a basically government sponsored monopoly and with absolutely no limits on what they can charge. And so it's again hurting consumers. So that's one of the things we're working on. Another thing we're working on is trying to improve availability of mortgages for condominiums. Condominiums in the US have a tendency to be the first home a lot of people buy, especially in cities. And some of the rules that have come out have made it much, much more difficult for borrowers to buy condominium. It's very tedious. There's a lot of regulation. There's a lot of documentation that has to go into it. And some of it is a little overkill. You may remember the building that collapsed in Miami a couple of years ago, Surfside, killed a bunch of
Yes.
people. Horrible, horrible thing. This building was 40 something years old. It had seawater in the parking garage, which is going to undermine the footings of the building. And because one building collapsed, we have to have basically engineering on other condominiums. You're not going to have that same issue on a 10-unit condominium that's wood frame and stucco, in Santa Monica, for example. Again, it's some overkill. And then some of the other things we're working on are trying to change the loan officer compensation rules so that we can offer lower rates to borrowers and loan officers get to make a fair living. So those are some of the things we're doing, but we're there. We go in, let's see, we go to Washington, D.C. twice a year. We meet with the regulators, we meet with Congress, and, I'm pretty active in that. Some of the other initiatives that we're working on with the National Association of Realtors is trying to increase the loan levels in certain metropolitan areas. So Los Angeles, for example, has more expensive real estate than Des Moines. The Fannie Mae should buy larger loans. And in a way they do, but they penalize people for buying a larger house. They charge more. So those are the kind of things we're working on. And everything we do, we believe, helps borrowers. As community lenders, we know our borrowers, right? We're not just some bank. So those are kind of the things that we're trying to help. And if, we believe borrowers will benefit in the long term from some of our advocacy.
Right. Right. I think the way you described the borrowers, I think is so important. You have such a close relationship with them, and you know them so much better than what a bank would, right? With a
Yeah,
bank, you're basically a number, right?
for sure. And even some of the large independent mortgage bankers like a Rocket Mortgage or, those guys, they advertise on TV and, you get, you're doing most of the work yourself over the internet. You're not going to get the professional advice you would get from, a really qualified mortgage banker.
Right.
And like I said, it's a very personal decision what house you're going to buy, what loan you're going to need, how long you're going to live there, all of those things. And I think, like you said, the independent mortgage banker that lives in its community, knows its community, has ties to the community, I think serves the borrowers better.
Right, right. And I think what you're doing with, advocating for changes on the law for the borrowers is so important, right? Because it's as a first home buyer, that experience can be so overwhelming, right? And there's so much that they don't know, right? So being able to help them have a better experience and a better deal for them, I think it's very important.
It's scary. I mean, I'm CEO of the company. I don't talk to as many borrowers maybe as I used to, but you know,
Right.
it's really, really scary buying that first house. I know the first house I bought when I was 30. I was a kid who grew up in the Bronx in an apartment. I never lived in a house, unless you include the fraternity I lived in Vermont. But I never lived in a house. I'm buying my first house. Oh my God, I got to make these payments out. It was scary. Um, and then I sold that house and bought another house. It was more larger mortgage, even more scary. We have to be there to hold their hand and let them know we understand. And it's, not every borrower is scared, right? But some people, buy a lot less house than they can afford. But, the majority of people, this is a very, very big part of their money right now.
Right, right. And that's what I talk about, changing their people's life, because it can be changing on for positive or negative, right? It could be either, right? Yeah.
100%. And, I'm not saying there's not bad actors in our business, but generally, if you're giving a borrower good advice and putting him in the right loan product, and helping them get that first home or second home, whatever, I think that borrower comes back to you. I mean, besides anything, it's just good business, right? I want to be thought of as a trusted advisor. And for most people, I think we are, but can't make everybody happy, obviously. But the whole idea is to generate referral business and repeat business. And you only do that by doing a good job for them.
Right, right. I interviewed a few people from the real estate industry, and they all share that same vision. I think it's so important because you're building that relationship for the long term. So it's not just a transactional business; it's a relational business. Building that trust and getting repeatable customers and referrals from those customers.
The last step in any sales process is satisfaction. You want a satisfied person for that very reason. You want them to come back to you and you want them to refer your friends.
Right, right. In particularly in such a regulated industry, and so many good actors, but also so many minefields, that even you know if you have good faith but no experience, you could also get into get a borrower in a lot of trouble, right? So
Yeah.
it is very sensitive operation, and it requires a level of professionalism and care that I see you and your team provides.
Well, we try. We do our best. Can't make everybody happy, but I can tell you that, we try to hold our loan officers to a very high standard.
Right, right. So, how should a first home buyer think about choosing the right loan without getting overwhelmed? What advice would you give them?
Well, the first thing you want to look at, number one, the first thing I've always asked every borrower is, what is your intention with this house? Are they going to bury you in the backyard? Are you living there forever? Right? Are you a young couple? Are you going to have more kids? Is this just a starter house you're going to live in for 3 years and then you're going to have 5 kids and you need a bigger house? Is it, I want to know what their plan is. Plans change, but you have to go in with some kind of intention. Nobody goes in and says, hey, I'm just going to buy this house because I like it. What do you like about this house? Right? Is it a house that's just done, or is it a house that's going to need some work? Are you going to have to put some money aside to make that, to remodel the kitchen, the bathrooms, put a pool in the backyard? Those are the kind of things that, a good loan officer is going to ask and try to figure out what's their goal in this house. And then the next thing is to figure out what they can afford. How much money they have for the down payment, and how much is that mortgage going to impact their life on a monthly basis. If you're making, for argument's sake, you make $10,000 a month, you can't afford $6,000 a month in payments. You can't. Uh,
Right.
and we look at gross income. We don't look at your net income. So if we say, that's 10,000 a month pre-tax, you're going to pay taxes on that, things like that. And it is different. So for example, someone who makes $1 million a year can afford to have a higher percentage of their income go towards housing because everybody eats the same amount of food, right? If
Right.
you're making $50,000 a year, you know, uh, paying 40% of your, and we'll let you get up to 50% of principal, interest, taxes, and insurance off your gross income. That's tight. I mean, that's really, really tight. Like you're going to eat a lot of mac and cheese. So, you want to make sure that it's going to fit within your lifestyle. And, you don't want the house to just you don't want to be house poor. And
Right.
we look at the whole financial picture. Do you have car loans? Do you have student loans? Do you have credit card debt? All of that stuff goes into deciding what kind of loan and is this the right loan product or the right house for you?
Right. Right. I think that that's so important because we as borrower want to buy the bigger house we can get, and then we get into um, house poor, right? You have this beautiful house, but now you don't have any money for groceries, right? uh, so
Yeah.
uh,
I mean, nobody wants to live like that.
right.
And it's just, to me, it's so important to really look at that overall picture. And by the way, it's not just income. If you're putting everything you have down on this house and you don't have any extra money afterwards, what do you do if your kid breaks your leg and you got to hit your $5,000 deductible? Holy crap. So you need to make sure that you've got all the resources you need to have a life, not just a house.
Right. Right. Yeah, I think that's so important. And the other thing that I've been doing personally is putting aside money to uh, put on capital, right? To reduce the loan, right? Um,
Yeah, a lot
um,
of people do that. Like, I hope I get this statistic right, but if you have a 30-year mortgage, and so that's 12 mortgage payments a year. If you were to make 13 a year, one extra payment a year, you amortize your mortgage from 30 years down to 22 and a half years. It doesn't seem like a
yes.
lot, right? But that has a huge impact on that, on paying off the principal. So I always advise people, do what you can to pay your house off. I mean, bad for my business. I want to lend people money, right? But at the end of the day, if you own your house free and clear, you know, you don't have as much stress in your life, do you?
Right. Right. I don't remember who's this actor, the um, Steve something. I'll remember it later, but he talks about this solace of fortitude. If you own your house, nobody can take
Mhm.
you out. He has a speech about that, right? Um, and yeah, what has been happening in Mexico is that they don't give you more than 30% of your gross income as a payment, right? How much you have to pay per month, right? It's up to
That's safe.
30% instead of 50, right? So what I do is I double I calculate whatever is going to be the payment, I double it, right? So I budget for the double, right? So I go, around 50, and that way, I'm paying the loan faster, way, way faster than, most people, right?
Absolutely. I mean, honestly, I have a second home at a local ski area, and my rate is so low, I haven't been making extra payments on it. But my rate here in Calabasas, I have a tendency to throw extra money at it because I agree with you. At some point, I'd love to pay it off. Plus, I'm getting
Right.
old. Yeah.
Right. Right. Yeah, see, I mean, I like that idea of leveraging your mortgage and your and the inflation and whatnot, but also it gives you peace of mind to own it. Yeah.
Absolutely.
Plus, in Mexico we don't have property taxes as high as in the U.S., so there's also that benefit.
Yeah, part of the cost of owning a house. Property taxes are cost. One of the problems in here is insurance. California,
Yes.
Florida, Texas, very hard to get insurance and very expensive. I mean, I've got a friend who's got a very nice house. I think his insurance premium's like $120,000 a year.
Wow.
Ridiculous. It's a very expensive home in a very expensive neighborhood. But when he told me that's what his last quote was, I was blown away. Mine's a lot. It isn't 120 grand, but certainly more than I'd like to spend. And it's more
Right.
than I used to spend. It actually, after the big fires in the Palisades a year and a half ago, they canceled a lot of insurance. My insurance went up threefold,
Wow.
tripled.
That
Yep.
is a lot.
Yep. Yep. Yeah. Kind of sucks. You know,
Yes.
I've been living in the house for a while. I'm not ready to move yet, so I'm paying it.
Right. Right. Yes. Makes sense. Mark, I truly appreciate it, you being here today.
Thank you.
We're running out of time, but I want to thank you first and ask you if there's any final advice, any final remarks you have for our audience. The microphone is all yours.
Yeah, I think you asked me that piece of advice about somebody getting into the mortgage business. I was like, go find something else. It's a tough business. It's tough because interest rates go up and down. It's brutal. But I will say one thing, and my son who works at the company has figured it out. Everybody in my business is old. So I think it's actually a great time for young people to figure out how to get in the business. And there's a lot of opportunity there. But I don't know if I'd want to be an owner again. Too much stress.
Right. Right. Yeah. Now you're looking more to enjoy a quiet quiet afternoon with a margarita in your hand, right?
Yeah, I'm more of a Scotch guy, but yeah,
Yeah.
at the end of the day, retirement isn't in my future. I don't believe people should retire. I think they die when they stop working. So I'll be around and just dealing with the stress for as long as I can, I guess.
Yes. Well, I mean, there is something about if you stop doing stuff. I mean, the idea of retirement just doing nothing and staying at home. I mean, no, it sucks. You die sooner, so don't do that, right?
Yeah,
Stay
yeah,
busy. Yeah, yeah,
yeah.
yeah.
I believe in that. I do believe in that. Keep your mind active.
Yes, yes. But being able to delegate the business so the business can operate without you, that gives you the responsibility of managing the business, but the freedom to pursue more, hierarchy activities.
You're absolutely right. And I don't have a lot to complain about. I have a lot of hobbies and a good family, and they're my priorities. But this is a stressful business, but you have to also get away from it.
Right, right. Mark, thank you very much for joining us today.
Thank you. Thank you. Hope people find it interesting.